Hello and welcome. Good morning. You're watching Market Cafe with me, Snehi Shah, and with me is Shreyansi Singh. And well, you're watching ET now. Thanks so much for choosing to start your day with us. This is a show where we'll take you through everything that was happening across the globe while we were fast asleep in terms of policy action, in terms of the major events that happened overnight. Especially, we've got lots of action coming in from Wall Street. In the second half of the show, we'll delve domestic and we'll take a look at all the sectors and stocks that could be potential buzzers in today's trading session, and also what brokerages are flagging out for us bright and early this morning. So with that, let's kickstart the show then. And Shreyansi, good morning. US Wall Street, sharp sell-off, deep shade of red all across. Take us through what's happening.
Absolutely. Well, let's take a look at it. When you look at the three major averages, they notched a second consecutive day of decline. So that's the move that you've seen coming in as well. And when you look at the Dow, that dropped about 400 points. The S&P 500 as well dipped 1%. When you look at the Nasdaq as well, you're seeing a slip coming in of 1.6%. And what you're seeing is that investors are dumping large cap tech names as well. More on that later, but that was largely fueling Tuesday's losses and notching the worst day since January 2nd for the tech sector. Now, on Wednesday, investors will of course be watching out for Fed Chair Powell's testimony before the House Financial Services Committee, so that will be in focus. The central bank leader will be talking before the Senate Banking Committee on Thursday as well. So that's also something that will be in the spotlight as well. And this is largely the move that we've seen coming in terms of the tech sector that we'll be touching upon later. But when we look at the European markets as well, you're looking at the Pan-European Stock 600 that provisionally ended the session down about 0.3% thereabout, with the vast majority of sectors finishing in the red, even in the European market itself. So when you look at DAX, you're seeing a downtick of about 0.1%. When you look at CAC as well, you're seeing a downtick of about 0.3%. So that's largely the handover coming in. Definitely a sea of red, like you mentioned, Snehi.
Well, yes, deep cuts coming in from Wall Street. Let's see how that pans out for us. But with that, let's also take a look at what's happening in the world of oil as well as cryptocurrencies. And well, oil did see a slight bit of lower edging because crude oil futures edged lower Tuesday as China pledged to boost economic growth, and OPEC Plus decision to extend its production cuts fell flat with traders. OPEC and its allies called OPEC Plus agreed on Sunday to extend crude production cuts of 2.2 million barrels per day through the second quarter. Now, traders have worried for months that faltering economic growth in China and an abundance of crude produced in the USA above all will put downward pressure on prices. So with that, let's take a look at what happened with oil. You have WTI crude that was at $78.1 per barrel, and Brent crude at $82 per barrel, so comfortably above that 80 mark as we speak for Brent. And well, also another asset class, if you can call it that, needs to be marked and spoken about is cryptocurrencies. And well, what a move in Bitcoin we've seen, right? Because Bitcoin tumbled on Tuesday shortly after it reached a new all-time high for the first time in more than 2 years. Now, the price of the cryptocurrency topped $69,210 on Tuesday morning and then quickly pulled back. Now, the losses deepened in the late afternoon trading session. It was last trading lower by almost 6.2%, and let's get you the latest levels on that as well. And when I see cryptocurrency right now, you have Bitcoin at 63,421, a downtick of almost $4,200 coming in a single trading session, 6.2% lower off the day's highest point for cryptocurrency, especially for Bitcoin. And however, with Bitcoin on a hot streak, up 45% this year already, investors have already cautioned that things could soon cool off as unrealized profit margins approach extreme levels. And despite yesterday's immediate correction, the new record is a triumph for an industry in itself, right? Because that has long suffered from reputational and regulatory risk that seems to be at its worst just 2 years ago when bankrupt crypto lenders dragged down crypto investors and crypto exchange FTX also collapsed. So well, we have been seeing some moves coming over here, especially when it comes to Bitcoin. And at the end of 2022, as traders were trying to gauge the potential extent of the FTX contagion, Bitcoin fell to a 2-year low as well. The cryptocurrency fell 64% that year and has been fighting to prove its legitimacy ever since. But yeah, all-time high and then an 8% tumble build on to those gains, recovered slightly, and well, a 6.3% loss is where Bitcoin is currently trading at, Shansi.
Absolutely, and let's take a look at the central bank activity that takes center stage yet again. All eyes will be on Federal Reserve Chairman Powell's testimony at the Capitol Hill for a sliver of clarity on what way the central banks are taking when it comes to policy easing this year. With this congressionally mandated testimony coming before the House later today, Powell will be expected to present a sharper view of where things are without spooking jittery equity markets. Central to the question of how the Fed acts from here on out is its view on inflation and how Powell expresses that. In recent weeks, he and others have expressed satisfaction with the trend in prices along with apprehension that risks still lurk, saying it's too early to ease up on monetary policy, which coincides well with the January jolt of an inflation print. Investors will also be bracing for a rather jittery day on Wall Street, given that indices have been easing from their record highs.
Well, and let's keep it with the US because US services industry growth has slowed slightly in February amid a decline in employment. Although measure of new orders have increased to a 6-month high, pointing to underlying strength in the sector. Now, non-manufacturing PMI slipped to 52.6 last month from 53.4 in January, and services industries reported growth last month, including construction, retail trade, and public administration, as well as utilities and wholesale trade. Not just that, production accelerated with a measure of business activity hitting a 5-month high as well.
And as promised, moving on to tech, then users of Meta platforms Facebook and Instagram experienced login issues in what appeared to be a widespread outage. Globally, there were more than 300,000 reports of outages for Facebook, while there were more than 20,000 reports for Instagram. The outage lasted for nearly 2 hours. Meta Communications Director Andy Stone took to X to inform users that technical issues were resolved as the apps returned to normalcy.
Well, let's keep it with tech then, and Apple's iPhone sales have plunged 24% in China in the first 6 weeks of 2024. The decline in sales has plagued the tech giant amid increased competition from local phone makers, and Apple's chief competitor in China in premium smartphones, Huawei, saw unit sales rise by 64% in this period. This could fan fears of a slowdown in demand for the US company, whose revenue forecast for the current quarter was $6 billion below what the street had penciled in.
Meanwhile, shares of car maker Tesla took a beating for the second straight day after company's Berlin Gigafactory was forced to halt production due to a suspected arson attack. According to the factory chief, the facility is likely to be without power for several days and production is not expected to resume this week.
Well, all right, that's a wrap on all the important global stories that we've been getting for you this morning. But viewers, with that, we'll slip into a short break on this edition of Market Cafe. We'll look at the Asian markets when we come back, so you stay tuned. Hi there, welcome back. Thanks so much for staying tuned to Market Cafe. You're still watching ET Now. Now, before we take a look at what the Asian markets have done, another asset class that I would like to point out is gold, because gold has scaled a record high on Tuesday, moving further above that $2,100 per ounce mark in a rally sparked by growing bets for a US interest rate cut in June and on safe haven demand due to the conflict in the Middle East. So while expectations of a rate cut that might be happening faster in the US have been fueling gold, so we'll see what happens with that commodity. But yes, let's move on and let's take a look at what the Asian markets are doing this morning in trade. Well, not much happening in the Asian markets. Some subdued, some mixed action coming in because Asia Pacific markets have fallen across the board this morning, mirroring a tech slide on Wall Street led by Apple, following that report on their iPhone sales in China that we told you about. So, well, on the back of that, at least you can see Shanghai is down 0.2%, not doing much. A 7-point cut coming in over there, so rather flat. Hang Seng also just an 8-point downtick and less than 0.1% of a cut coming in, so rather flat moves coming in for Hang Seng as well. And let's also take a look at what's happening in Korea, and let's take a look at Kospi because shares of Samsung Electronics fell 1% yesterday. And the Kospi slid 0.2% on start. It's losing more, 0.6% downtick coming in for Kospi, 16 points lower on that index as well. Now, shifting focus to Japan, the Nikkei dipped 0.2% at open. However, it managed to stay above the 40,000 mark at open, but now it has slipped below that mark as well. 39,939 is where the Nikkei is at, a 0.4%, almost a 0.5% cut coming in, 158 points downtick coming in for Nikkei. Let's see if it is able to scale back to those 40,000 levels over the course of the day. And well, investors will also be watching for the fourth quarter GDP data from Australia later in the day. So on the back of that, ASX 200 down 0.3%. It started rather subdued and is right there when where it was at open, so 22 points lower on that index as well. Let's shift focus and talk about what our markets did yesterday. Rather tempered trading session coming in yesterday. So we did have a tempered Tuesday, so to say. So on the Nifty spot, we managed to close at 22,356. Nifty futures at 22,437. Implied indicating 22,404. Slight bit of a positive start for when you look at it on a spot basis, but rather tempered on a futures basis. And well, from the global handover that we are getting, especially the sharp cuts coming in from Wall Street, we can only imagine and we can only hope to see what happens over the course of the day for our market, Shreyansi.
Well, that's quite the handover to consider.
Hi there, welcome back. Now, in a big boost for Indian money market, the Bloomberg Index Services will include Indian bonds in the Bloomberg Emerging Market Local Currency Index and related indices in a phased manner from the 31st of January 2025. My colleague Anurag Joshi is joining in with the details. Anurag, good morning. Take it away.
Bloomberg has become the second financial index provider to include India's bonds in its debt indexes. So Bloomberg will include the Indian government bonds in its emerging markets local currency indexes, and this will be from Jan 31, 2025. Now, the inclusion of Indian bonds will be phased out over a period of the following 10 months, and by November 2025, the full value weightage of Indian bonds in the Bloomberg indexes will be added. Now, JP Morgan had decided to include Indian bonds in the debt indexes in September last year, and the JP Morgan's decision to include Indian bonds had led to forecast that about $21 billion would come into Indian debt markets through that move alone. So the weight of the Bloomberg, the inclusion in the Bloomberg indexes will be increased by 10% every month. This will be until October 2025.
Well, thanks Anurag for all of those details, but we also caught up with Hemant Mishra, co-founder and CIO SBE Capital. Listen in to what he had to say as well.
If you look at some of the rating companies, they've always expressed some bit of a concern on the government's budgetary deficit and the ability to finance it. Now, clearly with an additional liquidity pool, which is foreign in nature coming in, it will help finance the government's deficit. And will also reduce the cost of borrowing because the government can now borrow at a lower rate because there is more demand than there has been in the past. So that's the first impact. The second impact is, these are hard currency flows. These are hard dollars coming into the system and coming into the country's foreign exchange coffers. So that helps our current account deficit. Our current account deficit anyway looks good, at 1% of GDP. It's a fairly healthy number. But the incremental $45-50 billion will help India. If we need, we can import more, or if we need to kind of demonstrate a lower current account deficit, or if God forbid if oil goes higher with the Middle Eastern crisis.
All right, let's get a move on then. And the centre has extended the mandate for the country's power producers to import 6% of their coal requirements until the month of June. Prakash Priyadarshi, my colleague, is joining us on the phone line with all the details. Good morning, Prakash. Thanks for joining us. What are you picking up?
Yes, an important development is coming as on backdrop of upcoming summer season, the government has asked all power generation companies to import sufficient coal to meet increased power demand, which can be seen in the upcoming summer season. as per the Power Ministry's assessment, power demand likely to reach up to 250 gigawatt during April to June period 2024. Therefore, government has extended deadline to import coal for blending purpose till June 2024. Along with that, coal stock level at thermal power plants not sufficient to meet expected demand as per the Power Ministry's assessment. Supply of domestic coal will remain constant due to logistic issues, which is associated with the railways network. There was a review meeting in the Power Ministry with all the stakeholders, and after that, Power Ministry has instructed all generation companies to review coal stock level at a regular interval, so that uninterrupted supply of power could be ensured. All GenCos will have to import at least 6% of coal of their overall requirement in order to meet increased power demand going forward.
Well, thanks Prakash for all of those details. Moving on then, Chinese car maker BYD has launched its electric sedan in India. Seal electric sedan will be available in 3 variants, dynamic, premium and performance, and will be priced in the range of 41 lakh, 45.5 lakh and 53 lakh respectively. BYD Seal will be the company's third offering after EV6 electric MPV and Atto 3 electric SUV. Here's a slice of the conversation Sumit Chaturvedi had with the senior VP of the company.
Yeah, I think the BYD Seal, it's a futuristic luxury sedan, performance sedan, you call it. We launched it today. This is the third offering in India. It comes in 3 variants. The dynamic variant, which is a range of 510 kilometers NEDC cycle, and it's priced at 41 lakhs. The premium car, which is at 650 kilometers range as per NEDC cycle, priced at 45 lakhs. And of course, the all-wheel drive, which is called the performance variant, with the range of 580 kilometers as per the NEDC driving cycle, that comes at a price of 53 lakhs.
And what about the overall going from here or growing from here, both? How is it going to be for you?
See, I think we have now 3 models. One is a MPV, electric MPV, one is an electric SUV, and now we launched this electric sedan, sports sedan. So we are in all the 3 categories. This year we'll stabilize. We have been in the leader in the 30 lakh plus category. We want to maintain that with this BYD Seal offering.
Well, all right, let's keep it with the auto sector. And with demand anticipated to remain strong for luxury products, German car maker Mercedes-Benz expects India to become its 3rd largest market in its region overseas over the next 2 to 3 years. The region overseas for Mercedes-Benz comprises 118 countries, excluding North America, Europe and China. And India is the 5th largest market in the region after Japan, South Korea, Australia and Turkey. ET Now's Sumit Chaturvedi caught up with Sagri Sadian, the head at region overseas for Mercedes-Benz. Listen into a slice of that conversation.
When it comes to luxury, we see very positive development across many of our global markets. Specifically, when we come to India, we have been able to secure double-digit growth when it comes to the top-end vehicle segment. And of course, it's all about the luxury value proposition that we offer to our customers. What is becoming more and more important to our top-end customer is exactly how this luxury experience is curated for them individually.
And talking about electric vehicle and its future, in India, definitely we have seen a number of models here. What about the other markets? How do you see EVs taking over, internal combustion engine cars there? What is the outlook on that?
So we have a very heterogeneous group of markets where you see different levels of infancy when it comes to battery electric vehicles. In India specifically, we are quite encouraged to see that the sales for last year was at least 4%. Of course, it's at a lower infancy comparative to most other markets itself, but battery electric vehicle transformation is in line with moving with our customers' preferences. And we will transform at the pace that our customers expect us to transform and would transform. We create the tactical flexibility right now for our customers to switch between an internal combustion engine and battery electric vehicles itself. What is important is for us to increase the consumer awareness around battery electric vehicles and to build the confidence in these vehicles in the specific markets.
Moving away from that then, MGL cut prices of CNG by rupees 2.5 per kg to rupees 73.5 per kg. So what will be the implications of this price cut? Will it hurt Q4 EBITDA? Somit is joining in with the answer and more details. Somit?
Well, with effect from today, Mahanagar Gas, which is the gas distributor in the Mumbai and the nearby regions, has cut the CNG prices by around 2.5 rupees per kg to around 73.5 rupees per kg. Now, this is the first price cut that we have seen since October 2023. Now, why they have cut this prices? Because the gas sourcing cost has come down. Hence, they are passing this benefit to the consumers. Now, spot LNG prices, if you see, in the fourth quarter have averaged at around $8 per MMBTU as against $12 per MMBTU that we had seen in the third quarter of FY24. And also, there's a possibility that the APM allocation, which had taken a hit in the third quarter of FY24, might have been reversed in the fourth quarter. In Q3, the APM allocation was on the lower side at around 78%, so this might have increased in the fourth quarter, and hence the company has gone ahead and passed on this benefit of lower gas sourcing gas cost to the consumers. Now, what will be the impact of this? Now, this will make CNG more affordable when compared to petrol and diesel, and this could lead to more CNG conversions and better volume growth for the company. Now, post this price cut, if you see, CNG is now cheaper by nearly 53% when compared to petrol and nearly 22% when compared to diesel. Now, if there has been not if there is no lower gas cost for the company, but despite that they have given this benefit to the consumers, then the impact could be around 1.5 rupees on their EBITDA per unit, if you see, because generally a 2.5 rupees cut on the prices leads to an impact of around 1.5. However, despite that cut, if you see, the company's margin would continue to remain in the guided range that the company had given earlier, because in Q3 the EBITDA stood at around 13.3 rupees per SCM. And if actually the gas cost has come down, then it's quite positive for the company, because any price cut without any margin impact would lead to a profitable growth for MGL going forward.
All right, Swami, thanks so much for taking us through what's happening at MGL, and we'll be focusing on that stock today as well. But Swami, 3 months into the year, which are the stocks that analysts have turned sour on and the ones that look bright? Swami, get us the list and take us through the snakes and ladders analysis.
Well, firstly, I'll start off with the companies where analysts have actually reduced their buy ratings. In fact, they have gone to hold or sell. Now, Zee Entertainment tops the list. Nearly 15 analysts who actually had a buy rating on Zee Entertainment at the start of the year have now either a hold or a sell rating. Now, this is post the fallout that we have seen for the Zee Sony deal. For Ashok Leyland, if you see, nearly 9 analysts have downgraded their ratings so far in 2024, and this was on the back of a sharp run-up that we had seen, and because of expectations of moderation when it comes to the CV industry volumes owing to elections and higher base. When it comes to Indian Oil Corporation, nearly 8 analysts have downgraded their ratings on Indian Oil Corporation post the sharp run-up. The valuations had become expensive, and also crude prices have remained largely very volatile so far in 2024. For LTI Mindtree, it was a weak Q3 earnings and muted near-term demand commentary, which led to 8 analysts downgrading their ratings. And for SBI Cards, again 8 analysts have downgraded their ratings, and this is largely on the back of expectations of credit cost to remain elevated for the next couple of quarters, which prompted the street to cut their ratings. Now, let's look at the list where actually analysts have turned bullish, and first let's Infosys on the list. Nearly 10 analysts have upgraded their rating on Infosys to buy, and this is on the back of expectations of a better FY25 on the back of strong deal wins for Infosys. Apart from that, it's Dabur, which has seen around 4 analysts upgrading their ratings on the back of favorable valuations and expectations of a demand recovery in the second half of this calendar year. For delivery, it was the improvement in the profitability trends, and ahead of the seasonally strong Q4, we have seen multiple upgrades coming in. For Supreme Industries, it was a strong pipe demand and upgrade in the guidance that the company had given. And lastly, when it comes to Aurobindo Pharma, the stock had fallen sharply owing to the Form 483 that we had seen, owing to which, however, the company reported a strong set of numbers and also alluded concerns of investors related to this Form 83, post which we had seen multiple upgrades coming in for Aurobindo Pharma.
Thanks, Amit, for that roundup. Moving on then, during a conference, ace banker Uday Kotak emphasized the need for a balanced regulatory approach in various sectors. He cautioned against excessive regulations that could hinder India's growth, but also stressed the importance of avoiding too few regulations that might lead to trouble. Kotak also urged regulators to respond swiftly to crises and accidents rather than exercising undue caution in the context of the rapidly evolving technology space. He highlighted the pressure on financial watchdogs, including the RBI and the CCI, to strike a balance between regulations and innovation. Kotak also emphasized the necessity of addressing problems innovatively without sacrificing growth, particularly to achieve the aspirational annual growth of 7.5 to 8% over the next 20 to 25 years.
All right, with that, we slip into a short breather on this edition of Market Cafe, but we'll be right back with more stock-specific news and updates, so you stay tuned.
Welcome back. Thank you so much for staying tuned in. Well, let's take a look at what is happening in the futures and options space then. And Ansh is standing by with that roundup. Ansh?
Right, so starting with Nifty first, as you can see in the chart, Nifty seems to be taking strong resistance at that upper end of the range, which keeps the buyers a bit cautious. But if we see an up move today, then we may even see some heavy selling pressure at around 22,460, which would also be a new high level. Also, if we see the Reliance chart, Reliance, which holds the maximum weightage in the Nifty, is also trading near the upper range of the upward sloping channel as well. So this keeps Nifty's up move in limit. Moving on to futures and options, in index futures, we are seeing open interest declining by around 4% in Nifty, which indicates a long unwinding, again a bit of cautious signal. But if we talk about Nifty Bank, we actually had been taunting index from last two sessions that it has been hovering around that Feb month high. But in the previous session, the index has surpassed above that Feb month high decisively, which keeps the bias very positive. At least till we stay above that Feb month high of around 47,350 level. Whereas in index futures, we are seeing open interest increasing by 9%, indicating long build-up, again a very positive sign. Whereas on option front, today is a Bank Nifty weekly option expiry. So on option front, we are seeing call rating at 48,500 and put rating at 47,500. So the resistance is at around 48,500, which is around 700 to 800 points away from current level. Whereas the put rating is the support level, which is just 200 to 300 points below the current level. Whereas if we talk about FIIs, then index futures, they have added around 14,400 contract. This is the highest, biggest single session short addition seen in at least 20 sessions. So they are getting a bit cautious in the market. So overall, if we see Nifty looks a bit cautious, but Nifty Bank looks a bit positive. Lastly, let's focus on FNO stocks as well. That will be in focus. And we are seeing long build-up happening in Samvardhana Motherson, Tata Chemical and Bata India, whereas short build-up in Bajaj Finserv and Bajaj Finance. So keep an eye on the stocks.
All right, Ansh, thanks so much for taking us through that. But while you're with us, also take us through a list of all the stocks that could be potential buzzers in today's trading session on the back of their individual news flows.
Stock in focus for today's trading session, as they have received an order from NTPC for setting up a Singrauli super thermal power project stage 3 in Uttar Pradesh, and the order size is around 9,500 crore. Apart from this, Havells will also be in focus as a company is planning to expand its existing product portfolio with the introduction of kitchen appliances such as cooktops, hobs, chimneys and other appliances too. All Cargo Logistics will also be in focus as a company has purchased a land parcel in Gujarat for business capacity expansion, and JSW Energy is also in focus today as they have signed a BESPA for 250 megawatt and 500 megawatt for battery energy storage. Lastly, let's talk about Bharat Forge. So the stock will be in focus as the company has infused funds in Bharat Forge Global Holding, a wholly owned subsidiary of around 180 crore. So keep an eye on the stocks.
Absolutely, Ansh. We'll keep an eye on all of those counters, but what will also be in the spotlight will be the primary market. The 650 crore Gopal Snacks IPO will be opening for subscription today. Let's go across to Sharad for all of those details. Sharad?
Well, Gopal Snacks IPO opens today and the IPO closure date is March 11. If you look at the prices, it ranges between 381 to 401 rupees per share. And importantly, this is a 650 crore IPO, which is the entirely offer for sale. Our company did raise almost 194 crore rupees from anchor investors, and big names include Bay Capital, BofA Securities, and even White Oak Mutual Fund. Now, importantly, let's look at how the peer analysis stands when it comes to the valuations, and we have taken two peers, which is BKG and Pratap Snacks. And over here, if you look at it, currently the market cap to sales ratio, BKG is on the higher side, almost 6.7 times, while Pratap is almost at 1.7 times. There has been a correction coming in the stock, but for Gopal Snacks on a calculated basis, we are looking at 3.6 times on an upper end of the guidance. Now, if you look at the company itself, it is an FMCG company and deals with two important markets, the ethnic snacks as well as the Western snacks and other products. They're having exposure in India as well as global markets. And lastly, the Gujarat market, that is something where the chunk of the revenue comes, and roughly 80% of the revenue from operations in FY23 came from the state.
All right, Sharad, thanks so much for taking us through that. We'll be watching out for this IPO and how it does today on day one of its subscription reviews. With that, I'm afraid we're completely timed out on this edition of Market Cafe. But while we bid you goodbye, you stay tuned to the channel because the market takes all the action ahead.